Hey traders, this is Blake Morrow with Trader Summit. With me once again, and not often enough, is Michele Schneider. She is also co-founder of MarketGauge. How are you, Mish?
I'm great. How are you, Blake?
I'm great. You know, I'm excited to sit down and talk with you post FOMC. The markets have obviously been very volatile in recent weeks. How have you been navigating through the markets since the whole Russian invasion in Ukraine and rate hikes and everything else?
Well, we sort of had a vision really going back to 2020 after COVID and the nadir of COVID that we were going to get into a situation exactly what we had, which is supply shortages, demand rising, commodity prices rising, and of course, labor shortages and supply chain and Mother Nature only exacerbated that. And so we've been sort of in that position. We were long a lot of equities throughout 2020 and 2021, but actually as we got into the fall of 2021 and we started to see some of what I call my economic modern family rolling over before the SPY and the Qs did, we started getting more defensive in terms of equity positions and more into commodities. And then, of course, the Russian-Ukraine situation really took our commodities positions and sent something like wheat, which we've owned for a long time, skyrocketing. So that we kind of anticipated that we were going into the super cycle of commodities and that the economy and potentially the markets, as we're seeing now, would have somewhat of a sell-off, but not necessarily a major sell-off and more into a stagflation environment. And here we are.
Well, you know, before we actually hit the record button, we were talking about, you know, stagflation, inflationary pressures. What you're saying then is it's going to stay persistent, even though some of these commodities might come off a little bit. We're going to have persistently high inflation, but with the term stagflation, you expect the economy really to go into more of a recessionary type of period. Is that correct?
Well, I'm hesitant to use the R word,
okay,
because we're in a very different situation now than we were in other recessions. If you talk to an economist textbook, you have generally up to 3 years to see a recession after rates start going up, and that's why a lot of people are looking for a recession. But I think that's a very confining way to look at it, because what we did have that we've never had before, or I shouldn't say never, but at least in my lifetime, was a pandemic. And what that pandemic did was two things that I think will prevent a recession from happening. That doesn't mean that it couldn't happen down the road or things couldn't get uglier than they already are economically. But these two things are very important to think about. Number one is that typically in a recession, you have companies laying off people, labor shortage, or I shouldn't say shortage, shrinkage is a better word for it. However, because of COVID, because we've already had a labor, now I'll use the word shortage, and we still have 10 million jobs over available in the United States. And the higher level jobs, the high skill jobs, like let's say scientists, mathematicians, programmers, et cetera, are being really wooed with compensation packages and higher wages, et cetera. And pretty much everybody is being wooed with higher wages to get them back to work. That part of the recession definition, I don't see happening. People aren't going to be laying off people. They're desperate to get people. Okay, that's number one. Number two, again, because of COVID, is traveling, getting out, doing things, moving around. We didn't do that for 2 years, really. And now with the COVID, except for in China, and I saw a little bit of buzz about some of the Western European countries now starting to see an upswing in cases. Here in the United States, it seems to have taken a real back burner to all the other headlines. Sure. That doesn't mean it's gone away. That doesn't mean it won't resurface. But right now, we're in a situation where people are just so fed up with staying home, not traveling, going anywhere. Vacations are booked, cruise lines are booked. People are traveling. They don't even care about the higher airfares because of the oil prices. And so the transportation sector, and that was one of the charts we talked about showing, is giving us a sign not only of some strength in an area that's important to the economy, but also giving us a sign that recession may not necessarily be around the corner like many fear.
Mish, it's it's one of those situations with COVID and current market conditions. I mean, how many markets can any generation say that they've been through a pandemic? And so we are dealing with something that is really new to everybody, that is alive truly at this point in time. So it's like all of the textbooks, if you will, even though I don't know how many textbooks will be around in 20 years, but all the textbooks are being rewritten from a macro and economic standpoint at this time. So it's going to be real interesting to see how the markets respond. Now, I want to go to your comment about commodities, and then I want to talk to you a little bit about what you're seeing in the S&P and other markets really quick. But I want to ask you about commodities. We've seen a real big, and I'm just going to talk FX here. You're starting to see commodity currencies like the Australian dollar, the New Zealand dollar, the Norwegian crown, the Canadian currency, even some of the emerging market currencies are starting to do a little bit better in the current environment, even as stocks come down. And that's a correlation that most of us as traders have never really experienced over the last couple of decades. So what that tells me as a trader is that the appetite for these commodity, even currencies, are pretty high. So when you say that there's going to be a commodity pullback, do you feel that commodities are going to have that upside pressure still, like globally for a while?
Oh yes, absolutely. I quite honestly think they're just getting going, which is frightening when you think about it, because
Sure.
Obviously people have to pay for things and things are going to only get more expensive. But from a trader standpoint, it's a very exciting opportunity if, like me, you were an old commodities trader and waited 40 years for this to happen.
Right.
And I always say that there's ramifications that people need to be very aware of. People who trade commodities and make money off of rising prices in food, in oil, energy, metals, etc. Generally, it's because things aren't so good. I mean, drought, shortage, coup, war, etc. And so you have to kind of get rid of I'm making money off the backs of people suffering out of your head. And I always like to say at that point, it's good to do something with your money that's good, whether it's you're into sending it to Ukraine or feeding people who are having trouble eating, et cetera. So to that, just as an aside, that's how I've always reckoned with being a commodities trader first and foremost. That hasn't meant that I haven't traded stocks, which is just the opposite, because when you're buying equities, you're buying into the growth of America. Everybody's happy. So it's a whole new mind shift here, right?
Yeah.
To how to make money. So with that said, commodities right now, there was a perfect storm for the commodities. Number one, for years, you had declining supply because there was such a glut of price. Producers started rolling back how much they were growing in food, how much they were mining for metals, et cetera. Number two, you had COVID. So, and oil, by the way, as well. So you had COVID. Supply was now down because of all these years. And then coming out of COVID, you had this rising demand, which was, of course, as we said before, exacerbated by supply chain issues and labor issues. So that's the backdrop. Now you have Ukraine, which is amazingly rich in commodities, and actually from a food standpoint has enough commodities to be feeding 690 million people. That's huge. That's a percentage of the world population.
Yeah.
So this really disrupts things. And of course, we all hope that this resolves at some point, but a lot of damage has been done. It's going to take time for Ukraine to come back. So that's another thing. Now you have this COVID swing again, particularly in China, which was a big reason why, since they're such a large exporting nation, that we saw supply chain problems to begin with. As they started to ease, now you've got China shutting down again. So now that's everything that's been the backdrop. You also had very easy monetary policy, accommodative for years, 40 years actually. Then on top of that, you had no taxes for corporations. And on top of that, you had stimulus, government spending, yada, 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 yada. So, I try to stay away from the blame game. When I see people say it's so-and-so's fault, or it's this fault, it's the Fed's fault, it's Biden's fault. No, this has been going on for a very, very long time.
Yeah.
And yes, there could be policy mistakes, but you can't point a finger and say that anybody has caused this. This is just cyclical in nature. Commodities to equities went to 100-year low in terms of the ratio. Unsustainable. Okay, so let's talk where we are right now.
Let's do it.
Fed.
Yeah, let's talk.
I mean, shut up if I
this is great, and let's talk about the Fed. So here we are raising rates, and we've got stocks responding. And I'm going to just pull up a chart of the S&P so we can just discuss it as we go through the markets here. We got the S&P rallying after the Fed historically, just raised rates for the first time in forever. So what do you make of the market reaction here, Mish?
Well, I'm going to go back to history again. To me, this is a giant trading range. Another thing that I have been talking about for months and months, even before we got into 2022, that we were heading into a giant trading range. And it's not because I'm so smart. It's because I understand what history has told us the other time we were in a very analogous situation. We had the oil embargo in the early 70s. Then we had the metals go crazy in the late 70s, early 80s. We had food prices going up at that time. And then we had Volcker come in and put a kibosh. But up until from 1966 to 1982, when we got through the nifty 50, where we had huge amount of mega corporations controlling everything, they got broken up. And then you got into the Vietnam War. And I mean, there's just then political pressures at home with Nixon. Then, of course, the Yom Kippur Wars and the embargo and all this stuff. There's so much analogous to what's going on now, with some differences, of course. But if you look at 66 to 82, 15 years, the market basically stagnated. The Dow peaked at 1,000, dropped to 600. So that's 40%, right, in terms of today's percentages.
Yeah.
And during that time, had you put $100 in the market in 66, by the time of 1974 it was worth 50. And you didn't really start making money on that until 1982. So now let's fast forward to today. So we've had not an oil embargo, but we've had this Russian situation. War, not Vietnam War, certainly no degree, but could this go into some kind of Cold War? Possibly. You've got all the reasons we just talked about while we're in an inflationary period. So if you go to the market right here, what we have is another situation where things could go sideways, and we're trying to establish the range. So with the top of the range in the S&P to where we saw the February low is more like 18%, which tells me one of two things. Maybe because we're in a different point in history, our range becomes more 20%, and we last like that for another 3 to 5 or longer years, or we're testing more the middle of the range right here because we haven't even gotten to the moving averages yet. This is a good short covering rally, bottom picking, whatever you want to call it. But like that $100 that if you invested in the beginning of 2022, maybe it'll go down further, another 15, 20% from here, then find a floor. And it won't be until we have some real reason to see an economic growth other than coming back from COVID that we could get out of this period. And of course, we have to have commodity prices come down. And again, let's go back to the Fed. They raised by 0.25%. That's a joke, really. I was kind of rooting for them. It certainly wouldn't have been good for my metals positions or my wheat positions, but I was rooting for them to go to 0.5%, and they wouldn't. So this whole dot plot, we're going 5 times, 7 times, forget about all of that. What you have to keep an eye on is what do they do from here? Do they go up another 0.25%? Even if they go up another 0.5% and they get to the end of 2022, 0.75%, compared to where we were in 1982 when Volcker shot things up to close to 20%, it's kind of a joke. So what it's telling me is that the Fed is really still counting on letting inflation run hot, thinking it eventually burns itself out because they don't want to kill an already delicate economy. And that's why I think the market will stay range bound. Long explanation. I can't hear you, Blake.
That would be my fault. Sorry about that. I was just going to say, I was just saying that that's fair enough. And we are seeing this recovery in the S&P. And if we are mid-range, maybe the 200-day moving average, you talk about a moving average, you can see how it's just starting to flatten out again. So what do you make of, I know you wanted to talk a little bit about gold. The gold market, we had this big move higher. Everybody knew why and had the reasons why gold would finally break higher. But it was really the Russian invasion into Ukraine that was the straw that broke the camel's back, that got gold really moving up back above 2000. How do you feel gold here about it, where we're at? Are you still constructive on gold, on being bullish, or do you think it's going to consolidate as well?
I'll give you two reasons, one technical, one fundamental, why I still think that gold is just getting started. From a fundamental standpoint, there's a few things going on. Number one, obviously, you got the Russian situation, but you also have a lot of European countries right now buying a lot of gold. And of course, Russia hoarding in gold as well.
Right.
You have also a situation where China right now is talking to Saudi Arabia about buying oil directly from the Middle East and not in US dollars, in yuan, which is extremely dangerous to us. Should that happen? Really, really bullish for gold if it does. So we also have the inflation, is why all the reasons I just explained doesn't look like it's abating anytime soon. So that's your fundamental reason. From a technical standpoint, everything we just talked about, well, IYT right now is doing better, and we talked about the special situation with COVID. But the SPY, the Russell 2000, NASDAQ, and the Dow are all in bearish phases. So you're in a situation where you're trying to bottom pick in a negative phase, hoping it goes up. And gold, you're in a bullish phase. You're above the 200, you're above the 50, you're above the 50-week moving average. And so when you look at it right now, after that giant, massive sideways consolidation that I'm seeing on your chart here, we broke out, we corrected right back to it. It's behaving like a typical commodity in a bull market. Technically, unless it starts to break down under those moving averages again, it's a buy on the dips.
Well, it's hard to be short gold, that's for sure. Well, Mish, I really love how you put it all together. I love, having an opportunity to speak with you. It's been too long. I want to say it's been a couple of months since I've had you on here, and we need to make sure we do this more often, because it's great visiting with you as always. So look, if I'm a trader at home and I'm watching this for the very first time, seeing you for the very first time, for some reason missed you on Fox Business or wherever else that you're at, how do I find out more about you?
Well, MarketGauge.com is our website. At Market Minute is my Twitter handle. I'm very active on Twitter. And if you want to contact me, that's probably the best way to talk to me. Also, if you go to MarketGauge.com, I say a lot of what we just talked about on media. They're not as generous, obviously, with the time that you just gave me, but that we have a tab on the top of the website that's media, where we post all my most recent media clips. So that's probably a good thing. And if I may plug my book for a second. I've
got your book over there. I'm just not going to get up.
Plant Your Money Tree. If you pick up the book, a lot of everything I talked about, phases, seeing things that are going counter trend, how to identify when to buy, when to sell, all that stuff, using the market phases, and a little bit about my economic family, which, by the way, transportation is a big part of, all there.
All right. Well, Mish, let's get all the viewers together and help push that book up amongst the ranks in Amazon. And I want to say thank you so much for joining us today. And if you guys and gals love listening to Mish, give her a thumbs up. If you're watching us on YouTube, subscribe to the channel so you don't miss any of our content. Mish, thanks for joining us today. And I look to speak to you very soon.
Thank you, Blake. You have a wonderful day.
You do.
Thank you, listeners.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.